Consumer news, we've been talking a lot about inflation, but with the Federal Reserve raising interest rates, you may be worried about how it will impact both your money and your budget. Here with the insight on what it means for you is financial expert and author of Good Money Revolution, Derrick Kinney. Good morning, Derrick. Good to see you again.
Good morning, Damon. Great to be with you as always.
I see you switched up the background a little bit today.
Actually, I'm here in Florida on vacation, but didn't want to leave my friends in Dallas Fort Worth hanging this morning, so here we go.
Well, look, we appreciate you being with us. So, Derrick, how does raising interest rates actually help reduce inflation?
So here's the logic of the Federal Reserve. First of all, they want to raise rates because it causes people to borrow less money on things like houses, cars, even businesses when they borrow to expand their business. And the goal is to engineer a slowdown in the economy. Here's the problem with demand is they're always on the verge of could they tip the economy into a recession, which could be even worse than higher inflation. So that's the logic right now. The bottom line, though, is it's a supply-demand issue. For example, until gas prices actually go higher, according to most economists, people won't stop spending less, which means there still won't be a real savings in gas for the near future.
Gotcha, Derrick. So where will consumers most quickly feel the impact of higher rates?
Yeah, right now, if you have a credit card that you're not paying the balance on every month, most of those cards in the teeny weeny fine print, as we like to say, the big print giveth and the small print taketh away. They will say they reserve the right to raise interest rates every single month as the Fed raises rates. So bottom line would be try to pay off your credit cards each month to preserve more money and interest. But also if you're buying a home right now, you talked about it earlier, while interest rates have stagnated a bit, we do think if the Fed raises rates again in July, mortgage rates are going to go back up again. So mortgage rates, credit card rates, anything where there's a interest rate attached to it is likely where it's going to pinch consumers right now.
So, Derrick, here's another one for you. For the people who are pros at investing or have been doing it for a long time or maybe novices or looking into it, we're seeing high levels of volatility in the stock market right now. What's causing that, and is it likely to continue?
Yeah, we're likely going to see continued volatility, and here's why. First of all, inflation is the highest we've seen in almost 40 years, and this is the first generation that's ever dealt with this high inflation. Most financial planning numbers show 1%, 2%. It was a non-issue. Now it's a huge issue for people to grapple with. The other piece of that, too, is will the Fed raise rates, and also corporate earnings numbers coming up in the next couple months, they're likely going to be lower. So I think as an investor right now, just expect a lot of volatility, but now may be a good time to buy while things dip if you believe long term they will likely go back up again.
And Derrick, as we wrap up, for investors saving for retirement right now, how would you advise them to invest right now?
Yeah. Bottom line is if you're 50 to 60 years old watching right now and you're about 5 years from retirement, you may want to ease back a bit, take the foot off the gas pedal a bit and put some more into conservative things like in your 401k where it says cash or short-term bonds. But if you're younger, 20, 30, maybe 35 or so, and you've got time on your side, this could be a great time to add money while things are lower. Keep in mind, though, it's going to be volatile, it could go lower, but moments like this where it feels the most crunchy financially, often in time, prove to be the best time to have invested.
Yeah, so Derrick, it's a holiday weekend. Folks are at home, many of them. Any other tips you want to leave with us before we wrap up?
Well, now is starting the second half of the year, so it's a really good time to get clear on what are my financial goals for the year. Inflation, global concerns, there's a lot of unnerving things in the world right now. What I would tell your viewers is this: pick out one financial goal and focus on it over the next 6 months with laser focus. Put it on a sticky note, on a note card, on your bathroom mirror, on your nightstand. That way you're looking at that all the time. So whatever the world does, you can still control your goal and your progress toward that goal. I think you'll feel a lot easier and better about the progress you make.
Derrick Kinney, always a pleasure chatting with you and seeing you. Thanks for your perspective. And for folks who want to find out more, you're the author of A Good Money Revolution.